Hello, everybody. Can somebody let me know if you can see my screen here? You could enter in the chat if you can see it. That'd be great. Okay. Thanks, Raj. Okay, let me turn on my camera here. One moment. All right. So, today we are going to be talking about how Airbnb investing has dramatically reduced my taxable income in this last tax year. So, one moment here. Okay, just making sure everybody's in. All right. Yeah. So today we're going to be talking about how Airbnb and investing dramatically reduced my taxable income in 2025. And this is basically going to be a case study on what actually happened within my own portfolio. So I am going to have the chat open. Feel free to drop in any questions you have, and I will go back at the end and go over those. But yeah. All right. So let's talk a little bit about me so that you all know more. If you haven't met me yet, my name is Liv. I am ex-corporate finance. So I have an MBA from the University of Colorado with specialization in finance. And I used to work in the corporate and investment bank at Wells Fargo, where I was helping companies that made between 500 million and 2 billion a year and had upcoming M&A needs. So that is my background before real estate. On the side, while I was doing that, I started becoming a real estate investor. So I've been doing this for 5 or 6 years now. I have a multi-million dollar portfolio and growing. I'm at about 3.5 million right now. And this is comprised of a few short-term rentals and one long-term rental, sadly. I am at the point now of work optional. While I definitely still enjoy making income now, it's really nice to have that sense of stability in the background as well. So I'm also a real estate agent and business advisor. Real estate has very drastically changed the course of my life and my financial position. So I'm really passionate about sharing that with other investors. And I'm always open to discussing my own situation with real estate to help others. So I'm pretty open about everything. So feel free to ask any questions you have. Okay, so let's, excuse me. There we go. Okay, yes. So also right here are some free resources to check out. So you can check out YouTube. I have an Instagram where I'll post sometimes like little stories about short-term rentals that are short little snippets. Or you can always, of course, schedule a call with me using this link. I'll have these all up at the end as well. So you will have access to these again at the end of the call if you don't get a chance to scan them now and you would like to. And give me one moment. I'm admitting a couple more people here. Okay. So to start out this presentation, of course, we have to have the disclaimer. So I'm not a CPA and this is not tax advice. I'm also not a financial advisor and this is for educational purposes only. Like I mentioned, this is really more about my personal experience. And it's actually just going into my actual numbers that I experienced this year. So it's really more about that. Of course, if you want to make a big tax decision, I always encourage you to check in with your CPA. Okay, so today we're going to be discussing why high earners are overpaying in taxes, how the short-term rental tax strategy actually works, because if this is new to you, it's likely different than what you may have seen or heard with other tax strategies before. The case study on my properties, my real numbers, and I said on one of my properties, but I'm actually going to show two of my properties today, and the actual numbers that I received. We're going to talk through what this will mean for your tax bill, as well as a path forward and what you need and how to connect with the right team in order to implement this strategy. So, if you're a high earner, you are probably overpaying in taxes. Most high earners, oops, excuse me. Most high earners would agree with that statement. A lot of people are pretty unhappy with how much they end up paying in taxes, especially as the tax bracket goes up. So, this is a really helpful strategy because, of course, if you haven't heard the phrase before, it's not about what you make as much as what you keep. So, these tax strategies can have really big implications on your financial picture in any given year and on an ongoing basis if you're familiar with the strategy. So, most high earners have been told the same three things around how to work with their tax plan. The one that, of course, we've all heard is max out your 401k. And of course, this is a great tool to help avoid paying some taxes. You are able to save a few $1,000s, but you're also likely still going to be writing a huge check. So an example of this is if you're putting in 24,000 and you're maxing out your 401k and you are at the 37% tax bracket, then that means that you could save about $8,880. So that's a really good start. Obviously, who doesn't want to keep an extra $8,880? But I think you'll find that the numbers in this presentation are going to be more impressive than this number here. The next tax strategy that many of you hear, and I say strategy in quotes, is to take your standard deduction. And this is really what everybody does. If you're working with an accountant, you're already taking the standard deduction. So it's not really a tax strategy, but it does give you a limited benefit when you're doing your taxes. The last one is accept that high income means high taxes. And this is one of the most expensive mistakes you can possibly make, and one that I used to make every year. And now looking back, I am sad thinking about the money that I paid in taxes because there's really another way around this that you will find you will probably like more. Okay. So let's talk through, first of all, why short-term rentals specifically for this tax strategy. Because if you're a long-term rental investor, you may not have even heard of this strategy before because it's really limited to short-term rentals for most investors. So with long-term rentals, losses are passive. You can't offset your W-2 income. So that's a big deal right there. That alone pretty much negates this as a viable strategy for most investors. Depreciation deductions are limited, and the tax benefit is just deferred and not immediate. Short-term rentals, on the other hand, are an asset class that the IRS will count in some cases as passive income. For that reason, losses are non-passive if you qualify with some of the pieces we'll talk about in this presentation. And it can directly offset your W-2 income. So you can have a paper loss against your W-2 income, and not just the income you're making on this investment property. You can take bonus depreciation in year one. So you don't have to wait for the life of the asset to go through. You can take it immediately on the year of acquisition in a lot of situations. So an immediate tax reduction on the next point as well. And you can typically qualify through self-management, and we'll talk through what exactly that means. But this is why this is really a niche tax strategy that's really only available to short-term rental investors. And this is why. It's because of that active participation requirement. Okay. So there are three components to consider when you're looking to do a cost segregation study and get bonus depreciation, meaning you're going to take a good portion of depreciation on your property up front at the beginning of your investment. So some things that you'll need to do in order to qualify for this strategy are materially participate in your property. This is what we talked about on the last slide. The IRS needs to see that this is an active investment. So what this typically means is you are actively managing your short-term rental. And I want to differentiate a little bit here. If you're somebody where you don't see yourself managing a property long-term, then that's okay. You can manage it in the year that you take bonus depreciation and then turn it over to a property manager after that. And I see a good amount of, high net worth clients who end up going that route. If you don't want to go that route, of course, we have resources to help you to manage really efficiently, as well. But so you do have to actively manage your short-term rental in the year that you're taking bonus depreciation. Self-management in year one typically qualifies you when you log the required hours, which we'll talk about, and this will unlock the non-passive treatment, which is the foundation of this entire strategy. The next is you have to get a cost segregation study done. So you may have already heard me say this term, and I'll actually show you a little bit of one of mine so that you can see what it actually looks like. But it's basically a study that reclassifies parts of your property on their depreciation schedule and is able to move some elements up towards the front. So while you're not able to write off the entire investment up front, it can push up a lot of it, as you'll see. So this is a really powerful tool. And for the cost of this, this is done by, you can do it yourself, but I really recommend getting a third party to come in and do a cost segregation study. We use a group called RCG. I highly recommend them. It cost us around $3,000 per property, which may sound expensive, but when you see the numbers, it's really a very minimal cost for us, relative to how much we're saving. So we did pay that per property, and the result is front-loaded deductions. And when you have those things, you can get bonus depreciation, where the IRS will allow you to deduct a portion of eligible depreciation in year one. So when you can take bonus depreciation when you have this cost segregation report and show material participation. And that's how this whole strategy works, is through these three components. Okay, so there are a couple of other rules that you should know about up front, as you think through what needs to be true in order to qualify for this strategy. So you need to have your average stay be under 7 days. This is why, so the IRS really categorizes this as more active participation because there's going to be more guest turnover and there's just more management involved, and more people involved if you have cleaners, all of that. So this is why it's shown as more of an active income category when your average stay is under 7 days. So your guest must stay fewer than 7 nights on average. Note that word average too. So if you get in here and you're at the end of the year, you can get an average from 2 stays. So I do have people at the very end of the year where they try to get this at the last minute and just get a couple of people in. But it's easier if you can do it a little bit earlier. There are ways to do it late in the year though. But this is what makes it a short-term rental in the eyes of the IRS and what unlocks the non-passive treatment. So for material participation, we talked about this. You have to materially participate. The most common path for this is self-management, in the year that you take bonus depreciation, which for most people will be the first year. So the two ways you can do that are either by logging 500 hours, or 100 hours and more than any other party. And we'll talk through what types of activities you can actually log within these hours. But if it sounds like a lot, there are ways to make this feel more doable. And I think you'll see this on the list of what typically will qualify. You also have to do that cost segregation study, and it's performed by a professional group. There are some online services where you can basically input your own assumptions. But for me, with the amount of bonus depreciation that I'm taking, I want to make sure that I'm really thoroughly protected. So the group that I use, they're pretty aggressive with the numbers that they give me. And then they also will back it up with the IRS for 7 years. And this is real substantial money, as you'll see in this presentation. So I really want to make sure that I'm protected, which I feel more comfortable with by hiring a professional group. Okay, the last piece is, of course, a CPA who knows about short-term rentals and this strategy in particular. Not all CPAs are created equally, and because this is a niche strategy that really only applies to real estate investors, this is one that it's really helpful if you have a CPA who has some familiarity. And just to kind of go over the process, because I think a lot of people end up unclear on this, you personally will go out and hire a cost segregation study to be done on your property. You'll get a report with that study that then you'll hand over to your CPA, who will be able to do the rest and will know how to implement this strategy. Okay. So, of course, one question that comes up all the time is, can I pull this off as an out-of-state investor? And I hear this all the time because I probably would say that at least 65% of my clients are actually from out of state. I get a lot of people who are interested from California and Texas and New York. And I am really excited that they can be open to having a mountain property in Colorado. And this is something that can be doable. So the answer is yes, you absolutely can, but you do need to have some planning as you think through how to do it. If you're an in-state investor, you probably need a little bit less planning, but you'll still want to have a plan on how you're going to log the appropriate amount of hours. So, what actually counts for putting these hours together? So, this, of course, with anything else on this slide deck, this is for information, and please always verify this with your CPA. But here are some common activities that I've used that clients will use when you're logging hours, whether you're doing that 500 hours or 100 and substantially more than anybody else. Some common activities to log would be guest communication, so responding to inquiries, booking messages, check-in instructions, all of that. Pricing and revenue management. So if you use a pricing software and this is something that you're adjusting as you're working or you're reviewing your calendar, updating maybe some of your preset pricing strategies, which I help my clients out on, um, then this is something that you can log as well typically. So most of my clients have no interest in cleaning their own Airbnbs. So I've had a couple that do actually, but almost none of them do. I certainly don't. So coordinating cleaning crews is a big one. Scheduling, confirming, following up on turnovers, coordinating maintenance and repairs, hiring contractors, supervising work, inspecting the property, all of that. Listing management, updating your photos. When you're getting the listing up, it does take a chunk of time to get all of your automation set up and to get the whole property up and running from the tech perspective. So you'd absolutely want to log those hours. A lot of people like to make a really nice guidebook that might take them some time to put together on Canva, with some welcome materials. So all of that you can be logging as well. Booking, keeping, and accounting directly related to the operation, of course. And here's one that I have found a lot of people really like, which is renovation and improvement work. So if the property's offline, but you're using it for tax purposes for this strategy, and say you're either renovating it before you launch the property, or maybe you're getting all of the furniture set up, these are hours that you can log. So what all I've seen people do, especially if they're out of state, is they may show up, stay at the property for a couple of days. They're overseeing, furniture being built. Maybe they're building some furniture while they're staying there, and they're able to log some pretty big chunks that way. So you can definitely get creative on ways to put more hours into your property while also, getting the benefit of the hours you're putting in from making your property more attractive. This is one of mine. And we put a good amount of hours in assembling this furniture, which we chose to assemble ourselves. You can also, of course, hire it out and maybe you want to supervise it. Okay. So, as I say that, while it's great to log your hours, I also don't want you to think that you have to necessarily be putting in all of these hours on an ongoing basis. So, this is a picture of me and my husband in Japan. While we were in Japan, we were able to get bookings, automated messages were going through, we received payouts, our cleaners were notified to go to the property, and everything was running smoothly when we took a month-long trip to Japan. And this is largely because we automate like crazy in our business. So something I always help my clients on is setting up automation so that you can self-manage if you choose to do so afterwards, after you've logged your hours from material participation. Because while it's great to put in hours up front, most people are not going to want to be involved with the property to that degree going forward. So there are ways to do that from out of state, or if you're like us, sometimes from out of country. Okay, so now let's get down into an actual case study. And I'll give you a couple examples of these. So the first thing I want to say is when I was setting up this webinar, I said 530, and that's because we were thinking of taking bonus depreciation on another one of our properties that's more expensive. And we ended up doing two properties, this one and one other that's one of our less expensive properties. So we got a really good chunk from it, but did not do the 530. I started advertising for this before we decided which one to go with. But as you'll see, the numbers are really compelling, you'll find, and are not super far off. So for this one, this is the first one I'll walk through. We bought this property a couple of years back for 615 as a three bed. We did renovate the property. We finished the basement and we turned it into a five bed. So we recently had it reappraised at 800,000. So part of that was a bump from the market, part of that was a bump up from forced appreciation. We're stabilizing at around 160,000 per year of gross revenue since this renovation happened. So while this presentation isn't specifically about cash flow, this house has been an absolute cash cow for us, I will say. So if you're curious about that, check in on some of my other presentations. But we're focusing more on taxes today. And it's located in Arvada, Colorado, and it's a five-bed property. Okay, so these are our actual numbers from the cost segregation studies that we received in the past, couple weeks here as we've been preparing for our taxes. So we received bonus depreciation on this property of $259,631. So as like I said in the beginning, putting money in a 401k is great and it's a legitimate tax strategy to do that. But to me, this is more compelling for most people. So if you're looking at an investment property, or maybe you already have this property and you're trying to figure out what you could expect to get on it, there's some actually pretty easy back of the napkin math that you can follow that I have found to consistently be accurate, both for my own properties and for my clients' properties. So that back of the napkin math is the purchase price less the land value times a range of about 35 to 45%. So to make that even easier, the land value is typically going to be around 15% of the purchase price. These are not perfect numbers, of course, but it really gets us close most of the time. So in this case, our appraised value was 800,000 times 85%. That's just me removing that 15% land value times 35% on the low end and 45% on the high end. So we figured we'd be in the range of 238,000 to 306,000, and we were. So we landed right below 260, which was 38.2%. So right in between these. So that was a good day to receive that one, but we still owed some taxes. So like I said, we decided to do a second property. And for this second property, this is one that it's not really the cash cow that the other one is. This one was self-designed. The other one used a professional designer, and it's also a four bed. And four beds get considerably less revenue than five beds. We actually purchased this property for kind of a different reason when we purchased it, which is that there's a garage that could very easily be converted into an ADU in the future. And we like that as an option as well. But it's not the same cash cow. We probably need to go back and redesign it at some point since it's self-design and we need to update the photography. But anyways, this property, we don't have a recent appraisal for, but we're guessing it's worth around 650. And it's stabilizing at around $80,000 per year. So while it's not a cash cow, we're making, a little bit of money, a couple $1,000, I think, on average. And it's a four bed located in Arvada, Colorado. But for the tax reason that we're discussing today, this actually had a really big impact on us this year. So on this property, we received a bonus depreciation amount in our cost segregation study of $206,343. So again, just going over that math, I think it's helpful to see it a couple of times with different applications. So with the 650, we're guessing it's around the amount that it's around worth, times 85%, meaning we've taken out that 15% that we're presuming for the land value, times that range of 35 to 45%, we landed on estimating 193 on the low end and 249 on the high end. So we were right again in the middle of that range, and our actual amount was 37.3. And it looks like someone just wrote on this. So um, let's see. I don't think I have that setting allowed. Um, 1 second. I'm going to close off all activity. Give me a moment here. I know there are some people who do this on Eventbrite, unfortunately. Give me one moment here. Okay. Um, okay, the question now is how do I get rid of that? Let's see. You know what? I'm going to stop sharing and reshare this. Give me a moment here. Okay, there we go. We're back. So, that was on the second property. Okay, so the total write-off amount that said with both of those combined is $465,979. So it ended up being really sizable and basically fit what we were looking for our tax strategy this year. So I also wanted to show um, so I wanted to show an actual excerpt from one of our cost seg studies. And this is kind of interesting to look at because as you'll see, you can see how they're, adding different costs here. So our cabinet knobs or pulls, they gave them $28. You can see, by blinds, they're really looking at everything. And there's just a super long list. There will be this long compilation of different items and how much value they're allocating um, based on what you have in your property. And this can really depend on what group you use. So, for example, with RCG, they've done a really good job of being pretty liberal with how much they're allocating to different items. But like I said, they're a professional company that'll back it up with the IRS for 7 years. And so they're basically making sure that they're maximizing the return that my husband and I can get, which of course everybody appreciates. So of course you see the number and then of the amount that you can write off. But the question that it always comes back to is, what are the actual real life implications of these reductions to your taxable income? So what I will show you here is that this is really not a straightforward answer. This is something that you'll have to discuss with your CPA. And the reason for that is it'll just completely depend on your tax bracket. And for a lot of people, this may end up being a blended rate between different tax brackets too. But just as an example to illustrate what the implications could mean is if this write-off amount falls within the 37% tax bracket, your realized savings, just based off of my, bonus depreciation amount in 2025 of that 465,979. If you're in the 37% tax bracket and this lands within that bracket, the realized savings would be a little over 172,000. So while the 8,000 for the 401k was great, of course, this one's a lot bigger. If you're in the 35% bracket, it could be up to 163,000, 32, about 149,000, 24% around 111,000, and 22% about 102,000. So like I said, you are likely going to be blended between different ones, but it really just depends on what tax bracket you fall into, as well as any other tax strategies you may be implementing with your CPA. But these numbers are really compelling, and I love cash flow and I'll take cash flow all day. But at the end of the day, this is a really big implication for the amount of income I'm able to take home for this year for 2025. So while we've mostly talked about tax benefits today, I'm not going to go into detail on any of these other things, but I recently did another webinar on why real estate works uniquely well as an investment vehicle. And it's really more than just the tax strategy because you can use leverage on it, meaning that you can put a smaller down payment on your property, but then when the property goes up to value, that goes up in value, that's based off of your entire asset value. So you can use leverage, just meaning you can put debt on the property. You get the tax benefits we discussed. If you meet the qualifications we discussed, you get debt pay down. The tenants that are staying at my properties are always paying down my principal amount on my mortgages each month. This is kind of like that hidden bump up that's adding to my net worth without me really thinking about it. We get appreciation on our properties, and of course, we get cash flow on our properties too. So there's just a lot of benefits to real estate investing overall, but tax benefits, in my opinion, are easily one of the most important ones. So that said, I really focus on working with investors and specifically short-term rental investors. So if you're unfamiliar with me or with the group that I'm with, Good Neighbor Realty, we have an extremely niche investor-focused process that's intended to help you to implement these strategies in a way that's effective for you and is efficient for you as well. So we help with goal discovery, meaning figuring out what strategy you want to do, understanding any restrictions on regulations, helping to find locations that have the best chance of cash flow, helping with property type. From there, we'll actually run property analyses. So we'll look at different properties and tell you what the cash flow potential is, any exit strategies you want to consider, as well as your different financing options will of course help you to secure the property like any other real estate agent. Well, we do this stuff as well, but it's really kind of where we start, where at for with adding value to our investors. And then also, we'll give you the tools to become a top performer. So, for example, I have a client working on purchasing a home they're planning to fully renovate, and I've helped them to find contractors that have reasonable prices and can do a really good job. We'll help to design and furnish the property by connecting you with a great designer as well as an implementation team if you choose to go that route. And we'll help you to know which amenities to install, who to get them from, help you to automate your business, all of that. So this is really built to basically be a business in a box for you, and to help you get the tax benefits, cash flow, or whatever other benefits you're looking for, maybe. So at this time, I'm going to open it up to questions. I am going to leave it in the chat since we had someone drop in and draw. So I want to make sure nothing crazy happens if I it up. So if you want to drop anything into the chat, any questions you have, I will take a look and start answering those. Get back to the chat. Okay. So I have a question. Let's see. Let me make sure this is the first one. Okay. So the question is, if you're not on title, when you buy the STR, but then the STR is under an LLC and you are on the LLC, does that still count as self-managed? So this sounds like kind of a niche question, and I don't want to advise you the wrong way. That's something that I would definitely check in with your CPA on, because this is kind of a niche situation. I would definitely check with the CPA. If you want a good CPA, just feel free to schedule a call with me or reach out. I'll reach out and send each of you a follow-up email to this presentation. Feel free to reach out if you'd like a good CPA recommendation who can answer that better for you. Let's see what else we have here. Let me stop sharing too. Okay. Um, who did you use for cost segregation? So I use RCG evaluations. They are so great. I have just found that I get the best numbers from them and they do a really good job. And Jennifer said, "What in the world?" I'm assuming that's when the person was drawing on it. You know, that happens all the time. It's weird. You can like shut down all of the access points, but I don't know. I don't know how that happens, but anyways, I'm glad they stopped. And I got a question. Are you going to email the slides out? And yes, I will. Also have a recording of this webinar too that I can send out if helpful. Okay. If you take bonus depreciation year one, can you sell the house the following year, either outright or 1031 exchange without being penalized? So that's a really good question. And that's something important to understand here too. So after you take bonus depreciation on a property, if you were to sell the property and not do a 1031 exchange, then you would have depreciation recapture. So you would end up having to pay for that. The way to get around this is by doing a 1031 exchange. So, what pe most people do when they're looking to sell a property that they've used for a tax strategy, what people typically do is a 1031 exchange, typically into a bigger, better property, and it's because they've earned some additional equity with time and market or forced appreciation, and they want to trade up for something bigger and better, and they'll 1031 exchange into it. And the other piece that I want to make sure you understand is so say you take bonus depreciation on a smaller property and then you go out and you buy a property that's double in value, but you've carried over some of what you brought from the previous property. You can take bonus depreciation on the value of the property of the new property that you didn't yet use on the first property. So hopefully that makes sense. It can get a little bit confusing around there, but you can use this as an ongoing strategy. The joke that real estate investors like to say is defer, defer, die. So you defer and then pass on your assets to somebody else and, reset it at that point. Okay. Yes, I can send the recording. So that will be going out as well. Um, and let's see, what's the criteria for 500 hours versus 100 hours for self-managing? That's a great question. So for the 500 hours, basically you can qualify in a couple of different ways, just according to the IRS code. So you can either put in 500 hours or 100 hours and more than any other party. So if you want to do the 100 hours, some people end up doing it a little bit later into the year so that other people like a cleaner won't put in as much time as you potentially, especially if you're going out and staying at the property to help set it up, that kind of thing. Then you can do the 100 hours. If you're buying it earlier in the year and you're planning to have a cleaning crew out the whole time, you'd want to track your hours to make sure that they're not putting in more time than you're logging on it. So it's just different ways about going around getting the hours. So I guess the answer is you can do both of them. Just depends on your preference. You mentioned that you did some renovations for the first house, um, and the house is offline. Yes, so I did a good amount of renovation, on that property actually. So we, had previously used it as a three bed, and I had self-designed it, and it was doing actually pretty well for a three bed. As you saw in this presentation, the bed count really matters in some areas, and Arvada, where these properties are, is one of the areas where it has a really big impact. So a really good three bed makes, 70 to 80,000 gross a lot of the time. A good five bed, we were anticipating that it would make about 120, but we ended up doing a lot better than that. And we're stabilizing more like 160 since the renovation happened. We have nearly a full year of data at this point. So we took it off market when we finished the basement and also redid design for, let's see, it was probably like 3 months total, like 2 months to finish the basement, add the bedrooms. We added a movie theater, and then another month to get all of the new furniture in and set up. So we had some time off market. We just paid out of pocket for the mortgage during that renovation, but it has been so more than worth it because going from, 75,000 of gross income up to 160 was, a big game changer. So I'm glad we did it. Okay. If our income is over 250,000, can we still take the deduction against our W-2? Absolutely. So a lot of the clients that end up coming my way are high net worth individuals who have really high incomes. And you can absolutely do this in any income bracket. There are celebrities that are doing this. It's a great strategy if you're a high earner. Absolutely. So there's no sort of cutoff or anything like that. You'll see politicians doing it. It's a great strategy that I really wish more people knew about and had access to. Does the number of bathrooms make a big difference, like the number of bedrooms? So I have found that it typically doesn't. So when I'm looking at a property, and I'll caveat that with more information, but when I'm looking at a property, of course, the biggest drivers are, how does it appear aesthetically? If you're not planning to renovate it, then you'll want it to be ideally kind of a turnkey property if you're not putting money into renovations. How are you planning to design it to make it attractive? And the bedroom count. This does vary by area. Like I found if you're looking more foothills areas, the bed count isn't as big of a driver. When you're looking at metro properties, like especially around Metro Denver, I really find that 5 beds are worth it to just get. With my clients, I'm very consistently shopping for 5 beds because I just find they get more cash flow. Um, for bedrooms, it's less big of an impact, I will say, outside of if you have a weird number of bathrooms. So what I mean by that is it's not necessarily going to be a big deal if you have a 5 bed and you have, 3 or 4 bathrooms, that's probably not going to be a huge driver. But if you have a 5 bed with 2 bathrooms, that might, pull a guest away because there won't be enough space for everybody to get ready. Um, so less of a driver, but still something to pay attention to. You just want to have, what's considered kind of a standard amount relative to your bedroom size. Um, is a CPA recording this in a Schedule C or Schedule E? That is such a good question, and I'm completely forgetting. But I can definitely give you the name of a good CPA if you're curious, and can get back to you. I'm filing my taxes right now, so if you had asked me 2 weeks from now, I'd remember the answer to that. But I will get back to you on that. Yeah. Any other questions that you all may have? I got it. Thank you. Okay, great. Yeah, so if you have anything else, feel free to drop it in. Otherwise, it's been great meeting with you all, and I hope this is really helpful. This is a strategy that I wish I had known about years ago because I've paid a lot of taxes that I really didn't need to pay. And I'm really glad that I'm not paying them now, and I'm trying to make sure all of my friends and family know as well. So I'm glad you all are here and learning about it. And I hope you all have a great. Oh, actually, you know what? I got a couple more questions here. Let me answer those. If you take bonus depreciation on year one, what happens the following years? Great question. So you'll take a big lump sum year one. After that, so I know you saw like in the back of the napkin math I had. You'll take that 35 to 40% range to 45% range that, is typically like 38 to 40% most of the time. You'll take that the first year, and then you'll have the remaining, whatever 60-ish percent that can be depreciated over time. And that will just resume a typical depreciation schedule that will go over time. So you won't lose out on the rest of the depreciation that's available on the asset. You just get to take more upfront and then use that cash for other things or other investments, whatever you want to use it for. Taking the bonus depreciation up front is great for initial cash flow, but it does mean you pay more taxes on income in subsequent years due to lower depreciation. That is true. Is there any way to avoid this other than to keep buying a new property every year? So that's a great question. It's not so much that you have to pay more taxes on your income, just to clarify. It's that you'll have, I guess in some ways it is, but it's that you'll take a bigger chunk up front, which basically means that the rest that's going on that typical depreciation schedule will be, yes, less in each year afterwards. Um, so what I would say is that a lot of people do end up buying a new property every year for this reason, and then they'll continue to accumulate properties that cash flow. And then if they want to do 1031 exchanges, then people tend to trade up into bigger and bigger places. That's what I see all the time and what my personal strategy is as well. I'll speak for myself. I buy every year, and I am already thinking through what I'm going to buy this year. And the key reason for that is taxes. Like I said, I love cash flow, but for me, the biggest driver is actually taxes. So I bought one very recently, in the last whatever 4 months, and I'm planning to look for another probably in the next month or two here. So I'm getting started early this year, and I have some clients that are doing the same thing too. But yeah, it does end up being an annual thing for a lot of people, especially with large tax liability. Okay. Um, Last call for questions here, and then I'll end in the meeting if I don't see more coming through. All right. I think that's all. So I hope you all have a great rest of your day, and thank you so much for taking the time to join me. I appreciate it. Talk with you all soon.